Do you want to achieve financial success? You're not alone. Everyone dreams of financial stability, the kind that allows us to live comfortably and make choices without the constant worry of money. But how do we get there? Well, we're about to dive into some smart hacks that can guide you on your journey to financial success. These are principles and strategies that have been tried and tested by many before us, and have proven to be effective. Firstly, we'll talk about the importance of making a budget. Then, we'll discuss the value of having an emergency fund that lasts 6 to 12 months. We'll also touch on the benefits of matching your 401k if your company offers a match. Following that, we'll delve into the advantages of investing in your Roth IRA for tax-free growth, and a mutual diversified fund like the S&P 500. Lastly, we'll explore how paying off your mortgage can help you retire early. Ready to dive into the first hack? Let's get started. First off, make a budget. Now you might be wondering, what exactly is a budget? Well, simply put, a budget is a plan for your money. It's a tool that helps you understand where your money is going, and more importantly, it helps you take control of your spending. Think of it as your personal financial roadmap leading you to your financial goals. So, how do you make a budget? Start by tracking your income and expenses. Identify essential expenses like rent, bills, and groceries, and discretionary ones like dining out and entertainment. Once you've got a clear picture, assign every dollar a job. Yes, every single dollar. This is known as zero-based budgeting, and it's a powerful strategy for managing your money, but making a budget is only half the battle. The real challenge is sticking to it. To do this, make your budget realistic and flexible. Adjust it as needed, and don't beat yourself up over small missteps. Remember, a budget is your financial roadmap. Stick to it, and it'll guide you to financial success. Next up, establish an emergency fund. There's a saying that goes, hope for the best, but prepare for the worst. This is precisely the mentality behind setting up an emergency fund. It's a stash of money set aside to cover the financial surprises life throws your way. These unexpected events can be stressful and costly. Here's where your emergency fund comes into play. An emergency fund is essentially a financial buffer. It's designed to cover a financial shortfall when an unexpected expense crops up. Without one, you may need to rely on credit cards or loans, which will only lead to more debt. So, what's the magic number? How much should you aim to have in this fund? Well, a general rule of thumb is to have enough to cover 6 to 12 months of living expenses. This might sound like a lot, but remember, this fund is meant to keep you afloat during major life disruptions, like job loss or a significant health issue. Now you might be thinking, that's great, but how do I start building this fund? The answer is simple. Start small. Don't feel pressured to fund 6 months worth of expenses overnight. Start by setting aside a little bit each paycheck. Over time, these small amounts will add up. You might also consider automating your savings. Many banks offer automatic transfers between checking and savings accounts. You decide the amount and the frequency, and then let the bank do the rest. Before you know it, you'll be well on your way to establishing a solid emergency fund. Another tip is to funnel any unexpected income into this fund. Got a tax refund? Put it in the fund. Received a bonus at work? Into the fund it goes. This strategy can help you build your emergency fund faster. Remember, the goal of an emergency fund is not to fund your next vacation or to buy that latest gadget. It's there to provide financial security and peace of mind. It's there to ensure that you can navigate life's stormy seas without sinking your financial ship. An emergency fund is your financial safety net. In the tightrope walk of life, it's the cushion that softens a fall and allows you to get back up and keep moving forward. Thirdly, maximize your 401k, especially if your employer offers a match. Now let's take a step back and unpack what we mean by a 401k. In the simplest terms, a 401k is a retirement savings plan sponsored by an employer. It lets employees save and invest a part of their paycheck before taxes are taken out. Taxes aren't paid until the money is withdrawn from the account. Now on to the golden goose of 401ks, employer matching. This is when your employer contributes the same amount of money to your 401k as you do, up to a certain percentage of your salary. It's basically free money towards your retirement. Just think about it. If your employer offers a 50% match up to 6% of your salary, and you earn $50,000 a year, that's an extra $1,500 towards your retirement every single year. And that's just the beginning. The real magic happens when you maximize your contributions. The more you contribute, the more your employer will match up to their limit. And remember, this money grows over time thanks to the power of compound interest. So the sooner you start, the better. The benefits of maximizing your 401k contributions are manifold. Not only do you get free money from your employer, but your contributions are also tax deductible. This means you can lower your taxable income now and pay taxes later when you withdraw the money in retirement, often at a lower rate. In conclusion, a 401k is a powerful tool in your retirement savings arsenal. It's a way to save for your future, receive free money from your employer, and enjoy tax benefits. So if your employer offers a 401k plan with matching contributions, do everything you can to take full advantage of it. Remember, a 401k is a great way to save for retirement. Fourthly, invest in your Roth IRA for tax-free growth, and consider a mutual diversified fund like the S&P 500. Let's start with the basics. A Roth Individual Retirement Account, or Roth IRA, is a type of retirement savings account. It's a little different from traditional IRAs, and here's why. With a Roth IRA, you contribute after-tax dollars, meaning you've already paid taxes on the money you put into it. The real magic happens when you start withdrawing funds at retirement. You see, those withdrawals are usually tax-free. Now, why is this such a fantastic tool for financial success? Well, imagine you've been investing steadily into your Roth IRA for decades. Over time, your contributions have grown significantly, thanks to the power of compound interest. When retirement comes knocking, you can withdraw all that growth without owing a penny to Uncle Sam. Now that's what I call a sweet deal. But where should you invest your Roth IRA contributions? That's where mutual funds come in, specifically, a mutual diversified fund like the S&P 500. Now, a mutual fund is essentially a pool of funds from many investors that's used to buy a broad selection of stocks, bonds, or other assets. When you invest in a mutual fund, you're buying a piece of this large, diverse portfolio. The beauty of this is that it allows you to spread your risk across many different companies or assets rather than putting all your eggs in one basket. The S&P 500 is a mutual fund that tracks the performance of 500 of the largest publicly traded companies in the United States. It's a good choice because it's widely diversified and has historically provided solid returns over time. To sum it up, a Roth IRA allows you to grow your money tax-free, while investing in a diversified mutual fund like the S&P 500 can provide a balanced exposure to the market. It's like a 1-2 punch for your financial future. Investing in a Roth IRA and mutual funds can help grow your wealth. Lastly, consider paying off your mortgage if you're aiming for early retirement. Why? Well, let's delve into it. For many people, their mortgage payment is the biggest expense they have each month. By paying off your mortgage early, you could significantly reduce your monthly expenses, making it easier to live on a smaller income in retirement. Now, imagine the peace of mind that comes with knowing you own your home outright. There's no more worrying about making those big monthly payments. That's a significant reduction in financial stress, which could lead to a happier, healthier retirement. But like anything, this strategy has its pros and cons. On the plus side, besides the reduced expenses and peace of mind, you also save a bundle in interest over the life of your loan. Let's say you have a 30-year mortgage. By paying it off early, you could save tens of thousands of dollars in interest. That's money that can be put to work elsewhere, like in your retirement savings. On the flip side, there are some potential downsides to consider. Firstly, you're tying up a large amount of money in your home, which could limit your financial flexibility. Also, by focusing on your mortgage, you might miss out on other investment opportunities that could offer higher returns. Additionally, you'll lose the mortgage interest tax deduction. But remember, everyone's financial situation is unique. What works for one person might not work for another. It's essential to consider your own circumstances and consult with a financial advisor before making this decision. In the end, the goal is to create a financial strategy that allows you to achieve your dreams. Whether that's retiring early, traveling the world, or simply enjoying a stress-free retirement. Paying off your mortgage early can give you peace of mind in retirement. So take the time to weigh the pros and cons and decide if this financial hack is right for you. So, there you have it. 5 smart hacks for financial success. We've covered the importance of budgeting, the cornerstone of any solid financial plan. It helps you understand where your money is going and how you can better manage it. Then we delved into the necessity of an emergency fund, your financial safety net for unexpected situations. We also discussed the benefits of maximizing your 401k, especially if your employer offers a match. It's free money that can significantly boost your retirement savings. We then navigated the world of Roth IRAs and mutual funds, emphasizing the value of tax-free growth and the stability of diversified investments like the S&P 500. Lastly, We touched on the idea of paying off your mortgage early if you're aiming for an early retirement. It's a big step, but one that can bring you closer to financial freedom. Remember, financial success isn't about getting rich quick. It's about making smart decisions and planning for the future. Good luck on your journey to financial success.